You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. Fed officials have a varying degree of urgency when it comes to policy easing, driven in part by different ideas of how far the federal funds rate is from neutral, the rate that is consistent with long-run price stability. Often referred to as R-star, the neutral rate acts as a benchmark that helps FOMC participants evaluate how restrictive or accommodative current policy is. On today's episode, we talk with Chris Lowe, Chief Economist with FHN Financial, about the difficulty in estimating R-star across business cycles, the neutral rate's role in the Federal Reserve's policy-making decisions, and how R-star estimates factor into bond market pricing. Stay tuned. Coming up soon, our interview with Chris Lowe, but first, a quick market update. The Federal Reserve cut interest rates by 25 basis points this week, as expected. While some analysts had penciled in multiple dissents favoring either no cut or a 50 basis point cut, there was only one dissent for 50 basis points. Overall, the summary of economic projections and press conference communicated a Fed that was operating with very low conviction about its projections for the economy and the path of monetary policy. There are still two broad camps within the FOMC that disagree about the state of the labor market, risks to inflation, and how policy should respond. Last week's inflation data were benign enough to keep the Fed on its rate cut path this week. The headline CPI rose 0.4% and the core CPI rose 0.3%. Evidence for tariff pass-through to consumer prices has been limited thus far, but the acceleration in core services prices could dictate how much additional policy easing happens in the medium run. Services prices tend to be stickier than goods prices and are more difficult to get under control once they start speeding up. Also last week, the BLS released preliminary revisions to payrolls data for the months between March 2024 and March 2025. The 911,000 net downward revision show payroll growth had slowed long before this spring, and the average monthly gain over that time was 71,000 instead of the originally reported 147,000. The preliminary University of Michigan sentiment survey showed a slight decrease in overall optimism and a slight increase in short and long-run inflation expectations. Perhaps more worrisome is the increase in those expecting to lose their job over the next 5 years. That number rose to its highest since July 2020. The Treasury market stayed range-bound the last 2 weeks, maintaining the post-payrolls rally the first week of this month. 10-year yields briefly touched below 4% but are trading a few basis points higher as of recording. The bond market is pricing in just under 2 rate cuts at the remaining 2 meetings this year, basically unchanged from before this week's Fed meeting. A few strong Treasury auctions last week solidified the post-jobs report rally and kept yields at the lower ends of their recent ranges. Both Stephen Miron and Lisa Cook participated as Fed governors at this week's meeting. Miron was confirmed by the Senate on a temporary basis the evening before the meeting began to fill the seat vacated by Adriana Kugler. 2 separate court decisions allowed Cook to remain in her position while she appeals President Trump's attempts to remove her from the board over allegations of mortgage fraud. That's all for the market update this time. Now our interview with Chris Lowe. Our guest today is Chris Lowe, Chief Economist with FHN Financial. Chris, good to have you back on the podcast.
Yeah, good to be here, Will. Thank you.
Our topic today is the neutral Fed funds rate, what it is, why it can be so difficult to precisely estimate, and how it's affecting Fed policy at this point in the cycle. Before we get into the weeds about the neutral rate, just definitionally, Chris, what does it mean when we talk about the neutral Fed funds rate? And is this any different from the natural rate?
Yeah, the neutral rate is the Fed funds rate that is consistent with stable inflation. The natural rate is simply the real neutral Fed funds rate, so the inflation adjusted. The assumption is that since the Fed is targeting 2% inflation, that's their goal, the natural rate in the long run is always 2 percentage points under the neutral, because the Fed assumes it's going to hit its inflation target in the long run.
And so this is sometimes called R star. Do economists think that R star is fixed over time, that it's this holy grail equilibrium number in the monetary policy universe for all of eternity, or does it change across different business cycles?
Well, yeah, they used to think it was constant, and that was an assumption in economics that lasted almost 100 years. And then we had the great financial crisis, and people's appetite for debt changed so dramatically that even at very low interest rates, there was not much interest in borrowing. And as a result, the neutral rate plummeted. It's closer to that long-term neutral now, but I think economists' faith that the number is fixed, that there is such a thing as normal, that's been pretty badly shaken. And because of that, the debate in every business cycle now is that the natural rate could be substantially different. And in fact, that debate is taking place within the Fed right now. It's evident in speeches by FOMC participants in just the last couple of weeks.
You talked about debt appetite as a reason why the decade after the financial crisis, before the pandemic, may have changed R star. People have really mentioned that R star is higher right now versus that decade before the pandemic. So what other factors shape R star? You said that it is the Fed funds rate consistent with 2% inflation, but there's so many other factors in the economy going on. So what has changed this time?
Yeah, if you think about the Fed's sort of the fundamental model that R star came out of is the Phillips curve-based Taylor rule. The idea that the gap between inflation and the inflation target is determined by the gap between unemployment and the unemployment target. And the way to move those is by raising or lowering interest rates, the gap between the current level of Fed funds and some hypothetical neutral. But that's a model with three terms: interest rates, inflation, and unemployment. The real world has a whole lot more. And we saw, for example, shortages during the pandemic. We saw huge stimulus driving the economy after the pandemic. And none of those factors are in the model. All of them, if they're big enough, will shift the relationship between those variables. And so one of the things the Fed is struggling with is determining whether the fundamental relationship between unemployment, inflation, and interest rates has changed, or is there some outside factor or factors that they should be taking into account when they do their analysis.
You mentioned fiscal stimulus since the onset of the pandemic, and I think that is a really interesting and very easy to see variable that can change the implications of these models. And I believe some Fed officials have even hypothesized that there is a short-run neutral versus a long-run neutral. So the stimulus that we saw was temporary. And does that mean that during those periods where the stimulus is really significantly impacting the economy, neutral could be higher because to slow down the economy to get to that happy equilibrium, we need tighter financial conditions, versus a long-run neutral when that stimulus kind of fades out from the picture?
Yeah, that's exactly right. And of course, one of the assumptions is that in the long run, the economy is functioning properly and wouldn't necessarily need things like stimulus to get going. So, the idea that you're striving toward this sort of policy utopia where the outside variables fall away. Of course, you never really get there. And so a good central bank will always be thinking first in terms of where's the long-term neutral, but then also what are the factors that might be shifting the short-term neutral and adjusting for those. It's one of the reasons, too, and Jay Powell talked about this in the months immediately after the election, whenever a new government comes in, there's bound to be new government policies. Those will affect the economy and the relationship between unemployment and inflation as well. You inevitably have a period of uncertainty while you wait for data so that you can judge what those impacts are. And then the Fed will do whatever they have to do to adjust for those.
You mentioned some disagreement within the FOMC about what neutral is, how close, how far we are from it. And we can see from the historical record of dot plots in the Fed Summary of Economic Projections, as far back as it goes, that FOMC participants have a pretty wide range of estimates for the longer run Fed funds rate when inflation is at 2%. In other words, they have a disagreement about what the natural rate is. What about the bond market? Does this concept of R star influence Treasury yields? Can we look at the Treasury market to see where investors are currently estimating neutral policy to be, and if it's any different than last cycle?
There's different ways to do it, but certainly one of the easiest ways is just to look at the shape of the yield curve and where Fed funds is relative to, say, the 2-year note. Or if the market thinks the Fed is really off the mark, then you've got to look further out on the curve. The idea is that traders believe that the Fed can only be wrong for so long. And then the economy responds, the Fed ultimately is forced to act, and so on. So to put it into clearer language, let's just look at the situation now where the Fed funds rate is higher than the entire bill curve. It's higher than 2-year note yields. And to have a normal shaped curve without any movement in the coupons, you'd have to see the Fed funds rate drop by almost 125 basis points. So the implication in the market is that the Fed is more than a percentage point above neutral at the moment. The market is less concerned about R star, that is the long-run neutral, than the short-run neutral. Market is sort of focused on what's neutral for current conditions because we trade off of data as it's released and becomes available. But there is, within the Fed, even a sense that maybe the best way to get to an understanding of R star is to look at where 10-year notes are trading. So long-term interest rates sort of implying where short-term rates should be in the long run.
You mentioned how a lot of the models estimating R star are pretty simplistic when it comes to the variables that influence the macroeconomy. It comes down to an output gap and a gap from the Fed's 2% inflation target. But I want to elaborate even more on how simplistic they could be just for financial conditions. So the Fed funds rate is the overnight lending rate, but there's so many other variables that impact the price of borrowing that slow or boost investment activity. Credit spreads, stock prices, long-term interest rates. The Fed and the federal funds rate affect those variables only indirectly, though. And to take one example, the Fed was on hold between July 2023 and September 2024. But over that time, 10-year yields range from 3.7% to almost 5%, which I think clearly shows financial conditions were changing, even though the Fed funds rate was staying the same. Do you think it makes sense to think of neutral policy as just the Fed funds rate when financial conditions depend on so many factors?
The short answer is no, that there are so many other things at work. But the Fed, I think, would counter that in the end, those are all short-term factors. Those are things that are affecting the short-run neutral rate, but not the long run. And in the meantime, they do have to make policy with the short run in mind. They can't only think long-term, particularly if some of the short-run impacts are substantial and are likely to last for a long time. I think a really good example is the inflation that came after the pandemic lockdowns, because in a way, most of it did turn out to be transitory, which is how the Fed characterized it from the beginning. But particularly service inflation turned out to be more stubborn. You know, inflation's nothing like the 6.5% that it was briefly in 2022. But on the other hand, we have had this sustained period of more than a year with inflation going sideways at about 3, a full percentage point higher than the Fed's 2% target. So there did appear to be a lingering long-term effect from the pandemic lockdowns that's proven really stubborn to tackle. That's a big part of the uncertainty of the way the Fed operates. One of the big shortfalls of thinking in terms of R-star. As some Fed officials have pointed out, the Fed is supposed to make policy with the long run in mind. The idea that they do have to make adjustments for short run impacts, but they shouldn't lose sight of the long run. But sometimes those short run impacts do have lingering effects.
Yeah, I think you make a good point about how if inflation is sustained for too long, it seeps into expectations. It can become embedded, like we saw for core services during that period of high pandemic inflation. And on the flip side, if we assume that the labor market and the overall economy equilibrates in the long run, well, there's still short-term scarring impacts, right? If the labor market deteriorates too much and the Fed decides, well, it's going to be in equilibrium in the long run, we don't need to ease policy, there are scarring impacts on those people that are unemployed, and it can make the adjustment process a lot longer, even if in some sort of long-term horizon, things eventually come back to the natural rate of unemployment.
Yeah, I think that's right. And then add to that, we do see sometimes policy changes that have lasting significant impacts on those relationships. And a really good example of that is immigration policy. When we had an effectively open door immigration policy, it meant almost unlimited labor force growth. And that put significant downward pressure on wages, particularly in that period from 2022 to 2024. And then we have a new administration come in, the borders are closed down, and all of a sudden labor force growth is significantly constrained. And we go back to the underlying demographics of an aging population being the primary factor controlling labor force growth. It's going to take a while before anyone, including the Federal Reserve, fully understands what that means in terms of wage pressure and inflation. We're not seeing anything in the data yet, but that doesn't mean we're not going to down the road. And by not seeing anything, I mean we are seeing significant changes in labor force growth, but we're not seeing wage pressures yet. But of course, that could happen.
We're recording this about a week before the Fed's September 17th meeting. The general expectation is the Fed is going to cut 25 basis points. Maybe there will be dissents for a 50 basis point cut or no cut at all. But I think what we have seen the last few months is this divergence within the FOMC about how to interpret the data pertaining to the trends you just talked about with labor force growth from stricter immigration enforcement. So there's a camp with Mickey Bowman and Chris Waller that says slower payrolls growth, deterioration in a lot of the data shows that we are behind the curve with a weakening labor market. We've got a cut. And then there is a camp that is a little more patient and thinks that, well, the unemployment rate is still historically low. In any case, those are two different camps about what to do at the next meeting over the next few months. Do you think there is also a divergence within the FOMC right now about how close we are to the neutral rate? So I believe Beth Hammack has said that we're pretty close to the neutral rate. And so in that sense, she doesn't see as much urgency to cut rates. Do you think that's playing into this, or is it really just the view of the current data that explains the divergence?
The divergence has been evident for a long time, and you can see it in the Fed's dot plot. The longer run estimates of Fed funds are the various members, the participants' estimates of what R-star is. We've also heard it in speeches recently. Jay Powell has said, like Beth Hammack, he said that he thinks we're close to neutral. John Williams just gave a speech recently where he insisted R-star is still very low. The fundamental difference seems to be, why do they think R-star fell in the first place? And Williams has done extensive analysis on R-star over the years. During the financial crisis, he decided that it wasn't necessarily, that is, the drop in the R-star wasn't necessarily because people's attitude towards debt had changed. He thought it was more a reflection of the aging population and demographics. And because the demographic trend hasn't changed, therefore he thinks R-star is still very low. I'm kind of skeptical about that. I think if you look at credit data, households had enormous exposure to mortgage debt before the housing crisis, and for years afterward, households were paying down debt. It's really the only expansion in modern history, going all the way back to World War II, where economic growth was positive, but for years, household credit debt outstanding continued to fall. People did find a way to work out from under their debt. And because of that, very low interest rates caused very little economic growth. There just wasn't the borrowing boom that you would normally expect. And I think that relationship has changed. People are starting to accumulate mortgage debt again. People are starting to use home equity to finance other things again. It's something that was commonplace in the 1990s, very rare since then, and starting to come back now. So I do think there is some evidence for the Powell-Hammock view that attitudes toward debt do affect the level of interest rates that are necessary to restrain economic activity.
Adding to that, right now we've seen a fiscal trajectory after those few years of confusion of the pandemic. We're still running at about $2 trillion a year in annual deficits. It'll be a little bit less, I think, with tariff revenues this year, but that's substantially more than we had before the pandemic. How does that impact R-star if we stay on this trajectory of massive deficits without managing our fiscal picture?
The critical thing is the market's belief in the ability for the people to pay back the debt. In other words, if you buy a 30-year bond, is it likely to be good for 30 years, or is there some risk of default down the road? The tariffs have had a huge impact on that math. If the current rate of tariff collections continues, we're talking about $400 billion in revenue a year, $4 trillion over 10 years. That would dramatically change the debt calculus. And I think it is one of the reasons we're seeing long-term interest rates in places like Japan and parts of Europe where investors' faith has been shaken in the fiscal picture. And yet long-term interest rates in the U.S. are stable. 30-year bond yields are just a little bit lower, in fact, than they were at the end of last year in the U.S., while they're higher in the rest of the world. I think that fiscal picture is something that affects interest rates over the long run. It's not going to be the primary factor in any one week, but it very often, when you look back, turns out to be the primary factor over the course of a year or a decade. And at the moment, it's moving in the right direction. But at the same time, we had gotten into a fiscal mess where deficit was growing faster than income, or rather the deficit was a bigger percentage of GDP than income was growing, which means the debt was growing faster than income. That is still true today, and it would take 4 to 5 years of discipline to get back to a position where the debt is becoming more sustainable rather than less sustainable. I think there's still a great deal of skepticism in the markets. Politicians have that kind of discipline, so we'll have to see. In other words, the tariff revenue is helping this situation, but how do we know they're not going to squander it once they are certain it's going to last?
Do you have an estimate of where R-star is right now? Is it just somewhere between the 2019 neutral rate and 2005 neutral rate, and it's hard to know where in that range with any precision neutral policy is?
I think that's right. And the way the Fed will feel it out is they'll set interest rates at a level that allows the economy to continue to grow. Right now, when you look at labor statistics, the unemployment rate is creeping upward, even though labor force growth is a lot slower than last year because of the lack of immigration. There are more people entering the labor force than there are finding work. That would suggest that the economy can stand to grow a little faster. And that's really the primary reason the Fed's talking about cutting rates at the upcoming meeting and beyond. But as long as we are close to their estimate of U-star, the long-run unemployment rate they think is consistent with stable inflation, they are going to be very cautious about how quickly they cut the Fed funds rate. They will be very cautious about how close they probably are to to R-star, and they're going to be careful because their thinking is if they lower rates below the neutral rate, if they stimulate the economy at a time when the unemployment rate is very low, the risk is that it could drop quickly by enough that it starts to bring inflationary pressure to bear. And that's very difficult to end without a recession. So, the answer is baby steps, right? The Fed will move in baby steps when they get to this point where they think they're close to neutral.
I can get behind the idea that there is a monetary policy that is neither restrictive nor accommodative, but I'm kind of skeptical about how helpful this concept is. So I went back and reread Chair Powell's 2018 Jackson Hole speech, his first one as Fed chair, and he focuses quite a lot on R-star. You can't have a Fed speech or big monetary policy concept without a great analogy. He talks about navigating the sea, looking at those different stars that we talked about, the natural rate of unemployment, 2% inflation, the output gap, etc. And I do think the analogy is helpful too in that when you're driving a boat, as I think even someone as experienced as me knows, you change your steering, but the boat's movement happens with a lag, much like monetary policy. You've also got the wind, the water current, so many other variables can change as you're steering too, just like with economic shocks. And there can be cloudy skies that make it difficult to see those stars. All that being said, do you think the concept of R-star, Chris, and the associated models are actually helpful? Or are there so many unknowable and fast-changing variables that it's all a distraction? Neutral policy may exist as a concept, but it's so difficult to pin down, it's not even worth modeling, and we should just know it by its works and take baby steps, as you said.
I think in the end, unfortunately, moving slowly, feeling it out is the only effective way. It's nice to have a framework that you can use to talk about policy, but at the same time, it's absolutely necessary to have the humility to know that it's theoretical, that there will be times perhaps when theory works just right, but most of the time there's other factors that prevent it from working just right. That was the genius of Alan Greenspan at his best, was realizing that in the end, there had to be a certain amount of policy discretion. Of course, Alan Greenspan at his worst is an example of what happens when the Fed gets that discretion wrong. This, I think, will always be the big challenge at the Fed. Optimally, the best possible central bank would be one that operates strictly by the rules and using rules that are really well known and that always work. Unfortunately, there's no such rules. And so in the end, there has to be a modicum of discretion. I'm reminded, as I think back over almost 40 years in the business, there's always two or three participants who are extremely faithful to the rules and will give wonderful speeches calling on the rest of the Fed to be more disciplined and stick to their guns. And inevitably, those are the participants who end up being the most obviously wrong. The ones who don't get that reputation, unfortunately, tend to be the ones who say the least. It's a really tricky job, monetary policy. And I think it's especially tricky in the last 6 or 7 years because there's been so many dramatic, sweeping fiscal programs that were put in place by both parties that complicate the math, make it extremely difficult to get the Fed funds rate in the right place.
I think it's interesting you bring that up because John Taylor's paper that formulated the Taylor rule, he had the benefit of the Great Moderation where things in the macroeconomy were quite stable. And so these models did not have to factor in all these unexpected shocks. But it seems like that smoothness was the anomaly, and we can't count on predictability moving forward necessarily. And, more discretion makes sense. And I do get your point that these models are helpful to show the public with some transparency, this is how we're thinking about it, even if we're not committing to it as a hard, fast rule.
Yeah, it's meaningful that the Taylor rule came into itself and was so effective that, in fact, there's central banks around the world, the UK, Australia, that effectively made the Taylor rule law. Policy had to follow the rule. It came into itself in a period of extraordinary fiscal discipline when Congress took its budgeting rules seriously. Fiscal stimulus was still a thing, but it was usually so small that it affected GDP by no more than a couple of tenths one way or the other. We've left that era. And when you are in a period where Congress is willing to throw around trillions in pursuit of one goal or another, that's an environment that's going to be very difficult for central bankers.
Chris Lowe, thanks for coming on the podcast.
Thank you, Will.
That was Chris Lowe, Chief Economist with FHN Financial. One of the last points Chris makes there is what I think is the main takeaway in discussions about the neutral rate. Even if it's difficult to identify, and it's a constantly moving target, it's a helpful framework for policymakers as they try to gradually use monetary policy to steer the economy. It's also an important tool for transparency so that the public has a better idea of what is guiding the Fed's decisions. As the Fed funds rate continues moving lower, the divergence of thought within the FOMC about where neutral policy is will become crucial to the medium-run rate trajectory. Fed officials are now able to speak publicly about policy, and the calendar is already full of scheduled appearances from FOMC participants who would assumedly love to clarify their respective outlooks on the economy and rates. Chair Powell has nothing scheduled so far. Next week on Friday, the August PCE is expected to show moderate core inflation and solid consumer spending. The Atlanta Fed's GDP Now currently estimates 3.3% third quarter annualized growth, supported by a 2.7% increase in personal spending. Such growth would certainly be an acceleration in economic activity after a sluggish first half this year. The following week, the ISMs and ADP for September, along with the August JOLTS, will set the labor market tone ahead of the September non-farm payrolls report on August 3rd. Investors currently expect slower payrolls growth to continue into Q4, but another uptick in the unemployment rate would encourage more urgent rate cuts from the Fed. Treasury will auction its 3-year, 5-year, and 7-year notes next week, the latest test for market appetite in intermediate Treasury securities since this week's Fed meeting. The 3-year, 10-year, and 30-year auctions went smoothly last week after a sustained bond market rally, and we expect next week's auctions to show robust demand in the belly of the curve. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.